The market is currently open, and right now, BigBear AI stock is trading at $5.11, down 0.78% in intraday action. While a quick look at the daily chart might make this seem like just another sleepy midday micro swing, there is a massive shift happening behind the scenes that most retail investors are completely missing. The expectation for a company like this has always been that it lives and dies by highly erratic, lumpy government software orders, keeping it tethered to the defense sector. But the reality is that they just secured their first major commercial user in global shipping logistics out of Panama, effectively proving they can transplant their high-security federal tracking algorithms straight into the private supply chain sector. This moves the goalposts entirely. The common narrative around this company is that it is a speculative vehicle, a cheap trading instrument to buy when macro tech trends rally and dump when interest rates stay high. But the deeper reality is that institutional capital is quietly starting to look at their balance sheet data, which shows a massive backlog expansion of $281.9 million, bolstered by a fresh $53 million sole source classified award. This sets up a profound conflict between the public perception of a volatile microcap asset and the concrete reality of a firm accumulating locked-in government and international infrastructure revenue. Looking closely at the recent price action, the stock is currently testing a heavy resistance band around the $5.40 level, following its strongest weekly performance in over 8 months, where it surged more than 20%. Daily trading volumes have spiked significantly above their trailing 30-day averages, a clear indicator that institutional accumulation and high-frequency trading accounts are battling for positioning. This sudden surge in liquidity has flipped sentiment on retail message boards to highly optimistic, yet this enthusiasm is hitting a wall of macroeconomic pressure. When you look at how individual brokerage accounts are handling this asset across popular retail trading platforms like the Robinhood app, there is a clear trend of retail participants chasing the momentum, while professional wealth desks are using the strength to evaluate the long-term sustainability of the software margins. Sector momentum across the broader landscape has been mixed, but specialized defense tech names are carving out an independent path. If you look at the major institutional trading desks, the question is no longer whether corporate data analytics has value, but which specific providers can secure their software environment against evolving threats. The intraday volatility we are seeing right now reflects a classic tug-of-war between short-term momentum traders and long-term fundamental allocators. Many users executing trades via standard online investment portals see the sudden single-day pullbacks as a sign of weakness, but the underlying tape shows that large block trades are absorbing the selling volume near the key psychological support levels. This behavior is highly typical for a stock trying to establish a firm structural floor after a massive multi-day run. The recent integration of top-tier customs and border protection expertise into their leadership team has also altered institutional perception, signaling that the company is actively positioning itself to convert its massive unbilled backlog into recognized high-margin software-as-a-service billing cycles. For any retail trader navigating online investing without professional institutional tools, parsing through this massive influx of corporate news can be incredibly difficult, making structured market data and careful tape reading essential for understanding where the smart capital is actually moving. To truly understand why the current market tape is behaving this way, it helps to look at the tools investors use to evaluate these positions. Investors using sophisticated self-investing platforms or automated solutions like Schwab Intelligent Portfolios often look for quantitative stability, which a highly volatile stock like this typically lacks on a pure trailing earnings basis. If you look at how it compares to standard market offerings across traditional investing sites, it does not fit neatly into a classic value or growth bucket. Many retail participants using standard individual brokerage accounts tend to judge the company based solely on its immediate daily percentage swings, failing to realize that institutional desks evaluate it based on contract duration, remaining performance obligations, and government budget cycles. When major platforms analyze these small-cap tech names, the focus is heavily weighted towards capital preservation, which is why the stock's lack of massive structural debt acts as an anchor for its valuation during periods of high interest rates, separating it from heavily leveraged software businesses that rely on continuous debt issuance to survive. Let us step back for a moment and look at the structural foundation of the business model to see how it operates outside of daily stock market fluctuations. Founded originally in 1988 with deep roots in complex federal analytics and later structured as a public entity through a major corporate combination in 2021, the firm specializes in high-consequence decision intelligence. Instead of building generic applications for mass consumer use, they construct highly secure data engineering, automated asset tracking, and vulnerability assessment tools tailored for national security, international trade compliance, and digital identity verification. Their systems are built to ingest massive, fragmented datasets from multiple sensors and historical records, converting that chaos into clear, actionable operational choices, where an analytical error could result in systemic failure. This defense-grade framework is exactly what they are now scaling into the private sector, applying the same automated compliance and biometric verification tools used by border agencies to international shipping containers and global logistics hubs to catch illicit tracking anomalies in real time. When analyzing the core financial print from their recent first quarter update, the numbers reveal the exact tension between the public market expectations and the corporate reality. Reported quarterly revenue came in at $34.4 million, which technically represents a minor 1% decline compared to the same period last year, but easily beat the broader consensus estimates that expected a much sharper drop. The real signal, however, was hidden within the operating metrics, where their total backlog jumped 14% sequentially to a massive $281.9 million. This expansion was driven heavily by that $53 million sole source classified award, proving that their federal client base remains deeply entrenched and dependent on their specific software architecture. Operating expenses did rise significantly during the quarter, landing at $34.76 million due to increased investment in product deployment and scaling their newly acquired digital identity platforms, resulting in an EBITDA loss of $15.96 million. This is the exact fundamental data point that short-term traders point to as a reason for caution, while patient capital views the expanding backlog as a forward-looking revenue guarantee that will stabilize net margins as these long-term multi-year contracts move into the active billing phase. Take a second right now and comment below how many shares of BigBear AI you currently hold in your personal portfolio, or if you are simply tracking its price action from the sidelines. It is always fascinating to see how the distribution of shares looks between long-term collectors and short-term momentum traders. Looking closely at the technical landscape of the broader market, retail investors have access to an incredibly wide array of execution tools, whether they are analyzing options flow on the Robinhood app or utilizing sophisticated charting setups on advanced online investing applications. For those managing their own retirement allocations through specialized vehicles like Fidelity IRAs or executing long-term asset positioning via classic Fidelity mutual funds, high-beta tech stocks like this are often viewed as satellite positions rather than core holdings. The institutional footprint across major funds managed by Fidelity Investments shows a clear preference for liquidity, which is why the recent increase in daily trading volume is so critical for attracting deeper institutional sponsorship. When a stock maintains high liquidity, it allows larger asset managers to build meaningful positions through standard Fidelity brokerage portals without causing artificial spikes in the market price, creating a more stable and resilient trading environment over time. As we look toward the final structural shifts for the coming year, the future outlook for the stock hinges entirely on how effectively management can execute on its dual-track expansion strategy. In the first scenario, if the Panama logistics deployment successfully demonstrates that commercial global trade hubs can drastically reduce smuggling risks and operational bottlenecks using their automated tracking software, it will trigger an immediate wave of regional adoption across other major port authorities, creating a massive stream of repeatable private sector revenue. The catalyst to watch in this bull case is a rapid compression of their operating losses, as high-margin software licensing outpaces their fixed implementation costs. Conversely, the primary risk scenario involves the inherently unpredictable nature of federal appropriations. If government procurement timelines stretch out longer than expected, or if administrative shifts delay the conversion of their unbilled backlog, the company will face prolonged cash burn pressures, forcing them to navigate a highly restrictive capital market environment. This brings us right back to the central conflict between expectation and reality, where the general market expects this asset to remain a highly speculative tech trade, while the operational reality suggests a structurally insulated defense contractor, quietly building an international commercial logistics footprint. To wrap things up neatly, the core investment thesis here is completely defined by the massive divergence between what the public believes about this asset and what the operational data shows. The market sees a volatile, low-priced software stock, heavily exposed to choppy government budgets and short-term retail sentiment swings. The reality, however, is a company with an insulated, expanding $281.9 million contract backlog, zero catastrophic debt obligations, and a freshly validated commercial logistics application that is successfully penetrating international maritime trade. While the near-term price action will undoubtedly remain sensitive to broader macroeconomic pressures and immediate technical resistance levels near the multi-month highs, the structural evolution of the underlying business model is undeniable. Investors navigating this landscape must look past the daily intraday noise and focus entirely on how efficiently the firm translates its massive contractual backlog into high-margin, repeatable cash flow over the coming quarters.